Greetings, everybody. Welcome to the weekly economic update for Monday, the 25th of April, 2022. Hope everybody's having a great day. It's pretty good here in Colorado. Had a nice weekend. Did a lot of laziness, which was always fun. So watched a lot of baseball. Astros pulled out a series, avoided the sweep yesterday. Mr. Jeremy Pena, hit a 10th inning home run to give the good guys a win yesterday, which was nice. So, which is always good for our Houston Astros. So, anyways, all right. So, like I said, hope everybody had a great weekend. Weather was pretty nice. We got a little snow last night. Nothing too dramatic. It has all melted by this point because it's up to 47 whole degrees. Quite balmy here in the mountains. So, all right, let's go ahead and dive in and take a peek and see how the markets did today. It was kind of an up and down day. It started, everything was in the red, and then over the course of the trading day, the U.S. indexes decided to make a rally. I don't know if it had to do with Elon or what the case was. So, all right, the Dow Jones finished up 0.7% at 34,049. The S&P 500 was up 0.64 at 42.99. NASDAQ was up 1.29%, closing at 13,004. Small caps are up a little more than 0.5%. The VIX today is up 4.61%. It's at right now 26.91. It had gone over 30 midday, so because I have alerts on my trading software, and it had let me know that it had gone back over 30 for a short bit. So the other exchanges here in the Americas, Canada was down 0.82, Brazil down 0.15, Mexico down 0.87. Moving over to Western Europe, Germany down 1.5%, UK down 1.88, France down 2.01, the Euro stocks down 2.15, Netherlands down 2.52. Spain down 0.9, and again, a whole bunch more 1s and 2% down till we get to the RTSI, which is a Russian exchange. It was up 1.38%. Then more reds. Let's see, I'll just point out the greens. See, Turkey was up 0.41. Saudi Arabia was up 0.6. And then we get over to the Asian markets. Japan down 1.9. Australia down 1.5, New Zealand down 0.13. Shanghai, the Shanghai in China was down 5.13. The SESE component down 6.08. The China A50 down 4.47. The DJ Shanghai down 5.34. The Hang Seng down 3.73. And the Taiwan weighted down 2.37. So the Asian markets got pummeled overnight. So I don't know if that has to do with the lockdowns that are going on in Shanghai. I was reading some articles earlier about the massive amount of disruption that's going on there right now due to their lockdowns and the coronavirus. Say it quietly so that y'all don't catch it. Anyways. All right, well, let's go ahead and dive into the weekly economic update and see what we got there. Week on Wall Street, hawkish comments from Fed Chair Jerome Powell overshadowed many largely positive earnings results, sending stocks lower for the week. The Dow Jones Industrial Average declined 1.86, while the S&P 500 dropped 2.75. The NASDAQ fell 3.83, and the internationals were up 0.5%. So it wasn't all just doom and gloom around the world. There were some up markets. All right. Focus comes off earnings with the inflation report in the rearview mirror and a Fed meeting 2 weeks away. Many may have expected corporate earnings to be in focus last week. Comments by Jerome Powell stole the spotlight. Investors began the week awaiting earnings reports, looking for insight into businesses handling the latest inflation, a jittery consumer, tighter monetary policy, and ongoing supply chain issues. Despite one high-profile earnings disappointment, corporate earnings appeared better than expected. By the time trading began on Thursday, 17% of the S&P 500 companies had reported, and 81% had beaten Wall Street analyst estimates. Investors responded positively, sending share prices higher until Powell's comments on Thursday afternoon triggered selling into the day's close and accelerating through Friday. Yeah, because I was listening to Peter Schiff over the weekend. He does a very good podcast. He puts out 2 or 3 a week, and he was talking. I don't know if it was Saturdays. It was over the weekend, Saturday or Sunday. He put it out, and he was talking about Powell's comments that he had caused a lot of uneasiness in the market, and I think the question that was posed to him was, what are your plans going to be if the economy starts to falter, or whatever the premise of the question basically being, if we run into any roadblocks, what's your plan? And he basically kind of waffled. He didn't really have an answer. And I think a lot of us who are not real pleased with what the Fed has done the last couple of years, have a pretty good idea. I think my own personal belief is that they'll turn tail and start lowering rates and buying up toxic assets off the open market like they've done the last 2 times we've had major financial problems here in the U.S. So we'll see. I think most of these people, you would think people who are supposed to be the brightest economists or economic minds in the world would have a clue that if you increase the money supply by 40%, it's going to have some dire consequences down the road. But hey, maybe they didn't take that class in college, and maybe I was the only one paying attention. I don't know. Anyways, let's jump back in. Where were we? All right. Powell's unnerves markets on Thursday at an event hosted by the International Monetary Fund. The Fed chair offered his view that it may be appropriate to move more quickly on raising interest rates. He indicated that a 50 basis point hike was on the table for the FOMC meeting. His comments also emphasized the need to restore price stability, recalling the successful efforts of former Fed Chair Paul Volcker, who used a series of rate hikes to tame inflation in the 1970s and early 80s. While some observers anticipated these comments, yields rose, stocks fell in response. All right. Got economic data coming out this week. Tomorrow on Tuesday, we got durable goods orders, consumer confidence, and new home sales. Thursday, we have GDP and jobless claims. Friday is consumer sentiment. Got a bunch of companies reporting earnings this week. Today, we have on Monday, we have Coca-Cola. Tuesday, we have Microsoft, Visa, Alphabet, General Motors, Archer Daniels Midland, 3M, Texas Instruments, UPS, DR Horton, and Chipotle Mexican Grill. Wednesday is Meta Platforms, or as we know it as Facebook, Boeing, Ford, Qualcomm, PayPal, Amgen, ServiceNow, and Norfolk Southern. Thursday is Apple, Amazon, Intel, MasterCard, Caterpillar, Merck, McDonald's. I'm loving it. The Southern Company, Eli Lilly and Company, Northrop Grumman. And lastly, on Friday, we got AbbVie, ExxonMobil, Bristol Myers, Chevron, Honeywell, Colgate-Palmolive, and 3L Harris Technologies. Busy week for earnings. So we'll see what effect that has on the equity markets this week. If they're good, we might see the market turn positive for the week. But again, with all the headwinds we have with rising rates, the economy's potentially going to slow down. I don't think that the stock market's going to be all that great in the short term here in the future. So, all right. First article, just a recap of today's market. S&P 500 turns positive as tech rebounds ahead of earnings. It's written by our friend Yassine Ibrahim over at Investing. The S&P 500 turned positive Monday despite worries about a global economic slowdown as investors piled into beaten down stocks ahead of a crucial week of quarterly results for big tech. Big tech moved off its worst levels of the day to help steady, led by gains in Google, parent Alphabet, and Microsoft ahead of their quarterly results expected Tuesday. Amazon and Meta, Apple also cut losses, though the latter remained in slightly under the flat line. These 5 mega cap stocks, which account for more than a quarter of the weighting of the S&P 500 index, need to deliver quarterly results that drown out the fears of global slowdown. Quote, in a nutshell, the street needs to see the fundamental drivers in play that on the cloud, enterprise, and consumer front to show the, quote, feared slowdown is more bark than bite at this point in the cycle, end quote, Wedbush said on Monday. Twitter, meanwhile, continued to hog the limelight. In the afternoon, it announced it had accepted a take-private offer from Tesla chief executive Elon Musk, who offered $54.20 per share. Twitter announced quarterly results on Thursday. Stocks started the week on the back foot after as global growth concerns resurfaced on fears that COVID-19 cases in China could spark another lockdown in the world's second largest economy. Energy stocks bore the brunt of the pressure, down more than 2% on fears that a lockdown in China could sap demand. Bloomberg reported, citing unknown sources, that demand for gasoline, diesel, and aviation fuels in China could drop by 20% year on year in April. Schlumberger, Halliburton, and Baker Hughes were among the biggest decliners in the energy sector. Financials, meanwhile, were also nursing losses paced by a decline in bank stocks as Treasury yields took a breather from their recent melt up. On the earnings front, meanwhile, Activision Blizzard was down less than 1% after first quarter revenue fell short of Wall Street expectations amid weaker than expected demand for its Call of Duty Warzone. Despite the rebound, some on Wall Street said there is still more downside ahead. Quote, "We don't see the daily, weekly, or monthly charts as necessarily oversold at this point, which implies there is more downside ahead before current selling conditions hit extremes," end quote, Janie Montgomery Scott said in a note. So, a positive day, for the most part. But like I said, don't let one day, one good day, change your battle plan for the next 6 months to a year. So, all right. Next article: Elon Musk buys Twitter for $44 billion. It's pretty short here. Elon Musk clinched a deal to buy Twitter Inc. for $44 billion on Monday in a transaction that will shift control of the social media platform populated by millions of users, mostly blue and pink-haired weirdos, and global leaders of the world's richest person. Discussions over the deal, which last week appeared uncertain, accelerated over the weekend after Musk wooed Twitter shareholders with financial details of his offer. Under pressure, Twitter started negotiating with Musk to buy the company at the proposed $54.20 per share. The deal ends Twitter's run as a public company since its 2013 initial public offering. Quote, "Free speech is the bedrock of a functioning democracy, and Twitter is the digital town square where matters vital to the future of humanity are debated," end quote, Musk said in a statement. Twitter shares were up about 6% on the news. Yeah, I don't use Twitter much. I go on there just to see what everybody's mad about. I'll peruse the trending, but anyone who goes and looks at my personal page knows that I'm not on there very often. I just like the format of Facebook better. You can, it's more conversational, and Twitter is just the posts all link all together, and it's a mess. So maybe it's just because I'm an old fart. I don't know. All right, next article has to do with our US dollar. US dollar climbs to 2-year peak as risk appetite tumbles, yuan drops. US dollar struck a 2-year high on Monday as a wave of risk aversion hit global markets, while the Chinese yuan was set for its biggest 3-day losing streak in nearly 4 years on growing worries of an economic slowdown in China. With war in Ukraine entering a third month and growing concerns of a China-wide COVID-19 outbreak sparking a rout in Chinese stocks, investors dumped currency market darlings like the Australian dollar and the offshore Chinese yuan. Against a basket of its rivals, the dollar gained 0.6% to 101.75, a level it last tested in March of 2020. Quote, "The dollar dominance can only be explained by fears of COVID continuing to influence China's lack of activity," said Juan Perez, director of trading at Monex USA in Washington. Quote, "Chinese data has been okay, supposedly, but per economic figures, but there's a growing concern that the no COVID or zero COVID measures are creating the need to revise outlooks further downward. China's shutdowns are killing global optimism," he added. China's yuan fell to a 1-year low against the dollar and was last down 0.9% at 6.4575 yuan per dollar. The Aussie, which was one of the biggest gainers in currencies in the first quarter of 2020, thanks to surging commodity prices, fell wildly. It dropped 1.5% against the US dollar to 0.7138 and fell 2.1% versus the Japanese yen. The Norwegian crown also fell 2% versus the dollar, which last traded up at 9.1235. Broader currency market volatility gauges ticked higher, with an index rising to its highest level in more than a month. Bank of America security strategist said that despite the pickup in currency market volatility, investors were long the Canadian dollar, Aussie, and euro. The euro's tiny gains after French President Emmanuel Macron comfortable election victory over far-right Marine Le Pen quickly dissipated, with the single currency down 0.9 at $1.0716 against the resurgent dollar. Yeah, I don't know how Macron won. I mean, there's been people angry in that country for years, the yellow vests and all the protesting, but hey, maybe they have the same voting machines we have here in America. I don't know. All right, so that's everything there. So my opinion on the dollar is that it's not so much that the dollar is doing really well, it's that all the other currencies suck more than ours. So, I think if currency was pegged to something specific like oil, metals, something that that the price was more stable, we wouldn't see that the U.S. dollar climbing against those other currencies. But all right, so the 10-year Treasury, next article here, 10-year Treasury yield is nearing 3%. That's a bad omen for the stock market. This is written by, who wrote this? Randall Forsyth. Sounds smart with that name. All right, interest rates may finally be getting real. Oh my gosh. To investors with a sense of history, the near zero and even negative interest rates of recent years might have seemed unreal, and indeed were unprecedented in the 5,000 years of recorded history of such matters. While the recent rise in bond yields has put rates back within the range of their historic norms, they are still under the level of inflation anticipated or current, meaning they're negative in real terms. The past week saw the benchmark 10-year Treasury real yield actually touch 0%, something it hadn't happened since March of 2020. That was when the Federal Reserve initiated its hyper-stimulative monetary policy, slashing short-term rates to almost zero and buying trillions in securities to pump liquidity into the financial system. With the central bank having just ended those emergency policies after some 2 years, the real 10-year rate finally moved up from its around -1%, where it was as recently as early March. Concept of real interest rates was developed by economist Irving Fisher more than a century ago. The nominal rate quoted on an instrument consists of a real rate plus the anticipated inflation over the instrument's life. Expected inflation is reflected in the break-even rate, calculated by deducting the real yield on Treasury inflation-protected securities from the regular Treasury notes yield. For a while, Tuesday, 10-year tips traded at 0% real yield, while the 10-year Treasury was quoted at 2.93%, which means the anticipated break-even inflation rate was 2.93. Back on March 7th, the 10-year note yielded 1.78, while the corresponding tips changed hands at a negative 0.99% for a break-even inflation rate of 2.77%. So the recent jump in Treasury yield was almost all in real yield. Positive real interest rates are associated with more restrictive financial conditions, which is what the Fed is trying to promote to curb inflation. That'd be a good idea to get started on that, guys. Negative real rates are almost a bribe to borrowers who can invest money cheaply, obtained in all manner of things, wise and otherwise, pumping up asset prices. The process works in reverse when real rates rise and turn positive. Getting bond yields above expected inflation would mark a milestone, maybe one indicating a shift to a restrictive monetary policy, notes Ed Hyman, the perennial top-rated economist who heads Evercore ISI, but it's more complicated, he explains in a phone interview. Viewed the other way around, the federal funds rate is even further below the Treasury bond yield, making policy very stimulative. Quote, you've got to get bond yields and Fed funds in the same neighborhood, end quote, he says. Right now, they are not even in the same zip code with Fed funds, the central bank's key rate. The only a quarter of a percentage point above their pandemic policy floor at 0.25 to 0.5, far below today's 10-year yield of 2.91. The real rate, negative 0.13 Thursday, down from zero earlier in the week, while up nearly a full percentage point in about 6 weeks, is still way below the most recent reading of the Consumer Price Index, which soared by 8.5%. In the 12 months ended in March, based on that current spot inflation rate, rather than the tips break even, the real 10-year yield is still deep in negative territory, about a minus 5.6%, according to Jim Reed, head of thematic research at Deutsche Bank. Given the vast gap, he is skeptical of the bond market's prediction of future inflation around 3%. I'm still not convinced inflation falls anywhere near enough over the next couple of years for real yields to get anywhere near positive, he writes in a research note. More likely, they remain negative owing to, quote, financial repression by central banks if real yields do rise. He warns, run for the hills given the global debt pile with potential explosion in debt servicing costs. Most people aren't rational enough to realize, most people aren't rational enough to analyze all of that, argues Jim Paulson, chief investment strategist at Lethold Group. So he doesn't think real yields matter so much. And he adds in a phone interview, low and negative real yields usually are associated with weak growth and poor confidence. So they might not stimulate the economy. Indeed, if people see yields moving back up, it may restore a sense of normality and boost confidence. For the stock market, he finds that nominal rates mean more than real yields. And the key tipping point is when the benchmark 10-year Treasury crosses 3% as it appears poised to do. Since 1950, when the yield has been below 3%, stocks have been fine. But they've fared far worse when it was higher and still worse when it topped 4%. When the yield was under 3%, equities annualized monthly returns averaged 21.9% versus 10% when yields were higher, according to Paulson's research. In addition, volatility was lower, 13.5% versus 14.6%, while monthly losses were less frequent, occurring 26.6% of the time versus 38.2% of the time. More on point, there was only one bear market when the yield was below 3% during the period studied, but 10 when it was over that level. Hyman worries that when the Fed funds rate and the bond yield do get closer, there could be a financial crisis. How bad a crisis? He notes that in 2018, when the Fed was raising the funds rate while shrinking its balance sheet, the S&P 500 fell 20% late in the year. Then Fed Chair Jerome Powell pivoted, declaring that he would be, quote, patient about further rate hikes. He wound up cutting rates in 2019. They're all cowards. Cowards. All right. I think that's basically it for that one. So I guess, pay attention to what's going on with interest rates. They are, going, if the Fed is, chickens out and reverses course, we're headed towards something really, really bad. We're only heading towards something real bad right now. So we'll see if what happens there. All right. And then this article, completely the other direction. 3 signs that recession fears are wildly overblown. Morning brief. It's written by Brian Sozy. So if I imagine most of what this guy wrote is completely off base, but we'll see. Tired of Wall Street talking heads pounding fears of recession into your overloaded brain day after day this month? So am I. There are valid reasons why some folks on the street are calling for a recession later this year or early next year. Models being toyed around with by pros are outputting increasing risk, recession risk. Interest rates are headed higher, maybe much higher, as we learned last week from Fed Chair Jerome Powell. And in this interview between San Francisco Fed President Mary Daly and our Brian Chung, inflation is hot and corporate earnings growth is slowing. I dig those financial modelers and their analysis. I used to be in their shoes. It is hard. It is a hard, thankless job. But all in all, it just feels goofy to hear recession calls picking up in pace. First, a few personal anecdotes to see what I mean. My local mall was mobbed this weekend and the weekends before. Think about it. People filled up on $5 a gallon gas to visit a mall selling goods that are 10% or more costly than this time last year. I also waited in line at Starbucks by my office for 19 minutes for 2 iced coffees last week, not because I messed up the order on the app, because the place was jam-packed. On Saturday evening, I drove past the local Olive Garden. Those are delicious. And it was crowded too. Well, maybe they're just poor, and that's where they get the most bang for their buck. You ever think about that, dumbass? Small signs from the road, but very much fitting with what I'm hearing in my convos with executives and other contacts in business. To that end, here are 3 more indications that recession talk is overblown. American Express has a big quarter. If the economy was grinding to a halt, American Express would have put up a wouldn't American Express wouldn't have put up a 30% increase in network volumes in the first quarter, and this fits squarely with what we saw from banks such as JP Morgan and Bank of America in the quarter. Strong spending on debit and credit cards. Amex also reiterated its full year sales growth outlook of 18% to 20%, something I don't think management would have done if the economy was beginning to tank. Quote, we'll see how the Fed does in sort of controlling that inflation with interest rate hikes as we go. But right now, I'm not seeing it a recession. American Express chairman and CEO Stephen Squeri told me in an interview. Squeri added travel and spending remain strong, with corporate spending gaining steam as companies get back on the road. Travelers roar back. Speaking of travel, earnings from major airlines were impressive, led by Delta and JetBlue. Meanwhile, shares of hotel giants Marriott and Hilton are near record highs. The summer is shaping up to be a boom time for the travel industry, which doesn't happen if the economy was teetering on the brink of disaster. Booking Holdings CEO Glenn Fogel appeared to agree with that when Julie Hyman and yours truly talked to him last week. Nose is runny. Allergies. And lastly, people are still buying premium TP. Consumer products, heavyweights Procter & Gamble and Kimberly-Clark had noteworthy sales strength in the first quarter. Why? Because each company is proving successful in passing along higher prices to shoppers. Consumers continue to navigate to premium products instead of trading down to cheaper alternatives. See private label. P&G CEO John Mueller told me. On that note, happy trading. So, yeah, yes, things look good today. I will, grant him that. But frankly, just because the average, everyday person is still out spending money like normal, well, almost normal, the average person has no clue what's going on in the world. They don't know what's going on with interest rates. They don't know what their government's doing. They don't know what the Fed is doing. So the fact that they're just, getting back to, quote, normal life, I don't know if that really, says anything about the chances of recession or bear markets here in the future. So, I mean, yes, people are traveling more now. Yeah, because you've locked them in their damn houses for 2 years. They're probably just saying, screw it. I know it costs more, but I'm going to go to, Six Flags or wherever they want to go. Maybe go see the Grand Canyon if you haven't made it out there yet. So, that to me is not necessarily a good reason to think that everything is fine ahead of us. And the fact that American Express had such good numbers, I mean, those are trailing indicators. That's what happened last year and last quarter. So, you won't really see it until it actually starts to spike. And, in my experience as a credit and recovery, associate back in my days at Citibank and Chase, I mean, you'll start to see it in your delinquencies when the economy starts to falter. Typically the person who falls behind on their credit card bills is usually the kind of person who has a bunch of occurrences at their work and is usually the first person to get fired when they need to, trim the fat at their company. So when the delinquencies, and I'd be curious to, I don't really have any friends in that business anymore. So, but I'd be curious to see from someone at, like a director level who can, see the in and outflows through the queues, what, the people who are, kind of your habitual delinquents, are they falling further and further behind? Are they, instead of just going a month behind, from time to time, are they now going 2 and 3 months late? Are they going, headed towards charge off? So, anyways, but like I said, I wouldn't, I understand this guy's optimism. You don't want to always be talking down about, where we're headed, but I mean, the writing's on the wall. I mean, we have to raise interest rates to, try and save this. I personally don't think they're going to be able to save it. I think it's all going to fall apart at some point. But, my goal is just to try and make as much profit off of their screw ups. Kept it clean. I didn't use the F word. But anyway, so, all right. Well, that's everything I have for today. I put my boy Barney, see him back there? Put him to sleep with my interesting commentary on the economy and the markets. So hope everyone has a fantastic Monday. I'll be back tomorrow with the Liberty Call. And if anyone needs anything from me, please go to dsafinancialgroup.com. You can book a meeting, send me a note, give me a phone call if that's what you'd like to do. So Otherwise, like I said, I'll see you tomorrow and have a great evening, folks. Bye.